And with that, we'll get things rolling. Our first speaker is Deven Parekh, who at least by assets under management would be the king of the New York venture community. But Deven's been a VC in New York at Insight since 2000, somehow or other since 2000. He's done 140 deals, and he just told me he thought that count might be a little low. I'm not sure how he pulls that off, but that has included, some names you obviously know, like Twitter and Alibaba, but as well some of New York City's great names like Yext and Buddy Media, whose founders we're going to have up here later today talking about what they're up to in the world. And Deven is going to be interviewed by Stephanie Mehta of Mansueto Ventures, which is the owner of Fast Company and Inc. And so I will turn it over to you guys, and thanks for coming.
Before we get started, I'd love to just get a little bit of a sense of who's in the room. So if you are a founder, could you raise your hand? Founders in the room? Investors? About 50-50? Awesome. Did that comport with what you expected to see in the room today?
Yeah, I just want to make clear, though, I did not fly across the country. I took an Uber here because I live in New York.
We're going to get into the whole New York Silicon Valley thing in a minute. To kind of frame the conversation, Deven, a couple of years ago, Insight commissioned some research on what you call scale-ups, which are different from startups. What do you see as the difference between the two, and what did your research tell you about the economic impact of scale-ups?
Well, the first thing is how rare scale-ups are. So if you think about scale-ups as the next stage from a startup, and we kind of define it as getting to $10 million of revenue, only 2 out of every 100 startups get to $10 million of revenue. So the odds of what we consider scale-up are just actually really, really low. But once you get to that level, if you kind of look at the impact they have on economic growth, close to 40% of all the job growth in the country comes from scale-up companies. So they have a very, very dramatic impact, and making sure that we have success and the companies get to scale up is obviously not only good for us as investors, but it's great for the country to drive significant job growth.
So in his introductory remarks, Brad set the stage for this notion that over time we've dispelled this myth that New York and the East Coast can't go toe-to-toe with Silicon Valley when it comes to raising money, but more importantly, when it comes to exits. You've had 2 significant exits in the last week or so, both East Coast companies. Tell us a little bit about the 2 exits and what you think that says about the prowess of tech on the East Coast.
Yeah, look, it's been a good week. This is a good day to be doing this. I wish every week was like this. I keep getting this feedback, but so Own Backup was a company that's based in New Jersey, so it's not New York, but we'll call that tri-state area and round to New York. Which was bought by Salesforce earlier this week for over $2 billion. And then we had Recorded Future, which was announced this morning, which is sold to MasterCard for just under $2.7 billion. That one's in Massachusetts, so it's, that's a little hard to round to New York, but it is East Coast. And I think that one of the things, in both cases, we're in those companies relatively early. In the case of Own Backup, like Series A. And both deals actually really consistent with Insight's model. One of the questions we always get is from our LPs is, I don't understand why you guys write small checks. You have these big funds, and then you write $5 and $6 million checks. And we're like, well, it would be great to know what's going to turn big and not. And I know you think we know that, but we actually don't. We have a hypothesis, and sometimes that hypothesis is with big companies, and sometimes that hypothesis is with a small company, and our job is to get to the maximum capital gain. So if you take the case of Own Backup, I think our first check was $5 or $6 million. If you take the case of Recorded Future, I think our first check was $40 or $50 million. But at the time that we sold Recorded Future, we owned 70% of the company. So we turned a minority deal into a majority deal. If you look at Own Backup, we started as a $6 million initial check, and we scaled it. And this goes back to the scale-up concept, that as we see these companies go from early stage to scale up, they do have more capital requirements. And sometimes that capital requirements is to scale marketing, product, technology. Sometimes it's for M&A, but sometimes it's for liquidity. Because the shareholder base that you have in a company at the start might not be able to make it all the way to the end. And so what we've tried to do is have a team of people that can kind of work with our portfolio companies at every stage and help them get from early stage to scale up. And if they do and they need additional capital, we want to make sure that we've got the capital availability to be there all the way to the end.
I do want to talk a little bit more about what that really looks like, what that kind of nurturing looks like, and we can stick with OWN. But before we go there, was there anything about being East Coast based that you think benefited OWN, or is there anything that OWN was able to do here that they might not have been able to do if they were headquartered in, and I don't want to pick on Silicon Valley, but in Austin or in,
New York is the headquarters of so many major companies, much more so than the West Coast. And when you're investing in enterprise software, yes, you have two things. You have to hire people, and the theory before is you couldn't hire people if you weren't on the West Coast. That's where all the talent was. Well, the last time I drove down the Henry Hudson Highway, Google's got a massive headquarters here. Facebook has a huge office here. A lot of software companies are here. So the ability to hire talent, you can do here for sure. But then the second thing is, once you have a great product, you actually have to sell it to people. Recorded Future, as an example, a lot of their customers are government, and a lot of their customers are financial services, where cybersecurity is critical. And guess where all those customers are? Here, on the East Coast. So I think access to customers is kind of relatively unmatched. And even if you look at the most successful West Coast companies, you often find that they're increasingly putting talent on the East Coast, particularly sales talent, because so many of the customers are here. And then the last thing, this maybe wasn't true 10 years ago, but New York City, if you look at the major large cities, and we have our problems, just like every city does, but I wouldn't trade with any other city. I wouldn't trade with San Francisco. I wouldn't trade with Austin. I wouldn't trade with a lot of other places. So increasingly, people want to be here. And so when you try to recruit talent, the ability to recruit talent to New York is so much better today than it was 5 or 10 years ago for those companies as well.
Yeah. So for Insight, what does nurturing a company from early stage to exit look like? Can you give us some tangible examples of how Insight as an investor distinguishes itself and really tries to partner with its founders?
We only have 18 minutes, but taking it to a high level, the way we've kind of thought about our value add team, which started with one person in 2000, is now 150 people, is we thought about what's every functional area that exists in a software organization. And we really just do software, right? So one thing is we're specialists. So everybody in the organization, that's all we talk about. That's all we think about. And we said you have sales, you have marketing, you have product, you have finance, you have strategy. And we basically created a center of excellence for each area. And we hired a combination of former operators and consultants into each one of those areas. So when we do diligence, and this doesn't really matter whether it's a $10 million investment or a $1 billion investment, and we have the full spectrum, groups of people from each one of those teams go in as part of the diligence and do an assessment of the sales process, the marketing process. And it's partially to due diligence. And I think people assume that if the reports come back and say, oh, the sales process is a C, that we're not going to invest in the company. And it's actually not true. If it's an amazing market and the company's growing really quickly, C is the best news ever, because what will happen when we turn it into an A, right? So for us, as an important part of the diligence process is to see what's the current state of the organization. And then what we further did over the course of the last 2 or 3 years, really led by Hillary Gosher, who runs our on-site team, is broke that group up into 3 different groups. So we have a group that just works with early stage companies. We have a group that works with mid-stage companies. And we have a group that works with kind of buyout late-stage companies. Because if you think about it, if a company's got $2 million of revenue, and we have a 15-person talent team that just helps with recruiting. Well, what a head of sales for a $2 million company is really different than a head of sales for a $200 or $400 million company. Same for a CEO. And so what we want to do is partner with teams, and we don't take a prescriptive approach. It's we go to people and say, look, we share with them after investment, here's your diligence. Here's what we found. Here's where we think the areas of strength are. Here's where we think the areas of opportunity are. And here's the resources that we have in each one of these functional areas that we can kind of partner with you on. We don't charge you for them, so there's no cost associated with them. It's up to you whether you want to take them. And we have a pretty high uptake rate, and I will say the strongest CEOs tend to use it the most.
We have seen a trend in recent years, in the last 2 years in particular, where investors are asking for more discipline from their founders. They're asking for a path to profitability. They want to see EBITDA. They want to see certain metrics. What's driving the trend? What's changed?
Well, two things. I'm going to answer the question, but I'm going to go with shift. How many people in the room have heard the term founder mode? Because it's gotten, yeah. So, one of the things I find interesting about that term is it kind of makes this kind of divergence. Like there's either founder mode or there's like management VC mode, and those are the only two ways that exist. And I just think that's total horseshit. If you look at Mark Zuckerberg, he's a founder. If you look at Elon Musk, he's a founder. I can go through a list of another 10. I think that most people would say they're ruthlessly focused on efficiency and making sure that investments have a return, right? So I don't really agree with the concept of founder mode versus kind of management or VC mode. But I think that, well, one, to answer now to go back to your question, we were in a zero interest rate environment. And when you can raise money, if I tell my kids that your budget for the month is $10,000, it will be spent, right? Like they're not gonna say, oh, Dad, I decided not to spend the last $1,000. And by the way, I don't think you can take the guilt. We as VCs were guilty too, right? Because we were seeing these companies raise money at higher and higher prices at very, very low dilution. And the way that happened was by getting more growth. And so that behavior was encouraged by the VC world as well. So I don't think it's fair to put it just on the founders because a lot of VCs encourage that behavior. But the world changed. And the world changed in that, I think for the good, basically said, sure, you can invest, sure, you can burn money, but you actually have to have an economic justification for doing it. And when I tried to explain it to somebody, the way I think about it is, if you start a restaurant, and like when a new restaurant gets formed, what do they say? What's the terminology in a restaurant? Well, do the four-wall economics work, right? Like, can you actually make money in that one unit? And if the answer to that question is yes, then guess what? You can scale it. And how do you scale it? You build a commissary kitchen, and you add headquarters people, and then you go build a brand. Guess what that means? Well, that one unit no longer makes money. But you know that one unit makes money, and now you can add 2, 3, 4, and 5. What we were doing collectively is like investing in restaurants that were losing money on a single unit and then layering cost on top. Doesn't really work. And I think we're back to the world, which is a rational world, which is how the world worked for most of history, and saying, no, the unit economics need to work. You actually have to look at lifetime value of the customer. You actually have to make sure that what it costs to acquire that customer is less than what the lifetime value is. And if you can find that, it's perfectly rational to spend money on marketing sales.
Shouldn't that always be the bar? I mean, we did go through this period of time where venture investors, who frankly have been through cycles before and have seen the ebbs and flows, nonetheless, we're encouraging founders to acquire customers at any cost, not worry about and so, I'm sure there are founders in here who feel a little baited and switched.
Yeah, I understand that. And I think that one of the reasons why, and I think it's a fair feeling, actually. I actually wouldn't debate the feeling. But what I would say is that and it's always easy in these things to look back and say it was obvious, right? But when you're a frog boiling it slowly until you die, you don't realize you're being boiled. But we saw more companies in 2021 that were growing north of 100% than any time in our history. And we've gone back and looked at the statistics. And it's easy when you have that data point to believe that there's something structural or fundamental that's happened in the inflection of spend. And I think most people, and I would include ourselves in that, over-rotated on that data. And the reality was some of that was driven by COVID budgets being pulled forward, IT budgets being increased because of COVID. And that when that went away, that kind of bump in growth wasn't really sustainable. And so a part of this was a kind of a misapproximation of kind of what the long-term growth rates really could be. And I think you're seeing that right now. Like you're in a much more rational economic environment, though I think overall the US economy is good, particularly if you compare it on a global basis. And you're seeing the growth rates aren't what they were in 21, but that growth is coming in a much more sustainable level, right? So I think there are mistakes made on all sides. I think some of them were legitimate mistakes based on extrapolating on things that you couldn't necessarily know.
So what's then the lesson for founders if we find ourselves once again in a go-go period? If investors are throwing money at you, does the founder say, I'm going to trust my gut, or I'm going to keep a little bit of my powder dry? How should founders, what lessons should we take in the last period?
The one thing I tried to, I'm sure I've made along the way, there's enough investments that I'm sure I didn't follow this rule all the time, but where I think I could, I never pushed founders to try to raise money at the highest possible price. Because I think you have a lot of companies right now. We just went through the 3-day operating review of every company. It takes 3 days. And there's a lot of good companies in there that are going to take a really long time to exit because they raise money at a price that it's dead. It's just fixed preference sitting on top. And so I really think that nobody knows the business dynamics better than you do. What we and other investors can bring to the table is a lot of pattern recognition of what people have done well and what mistakes people have made. But instinctively, nobody knows your market better than you know your market. And so if I tell you, why don't you spend another $5 million a year on sales and marketing because it will grow faster, it's perfectly rational to say, well, Deven, there's only 100 deals a year that happen in my business, in my market. And it's going to be 100 next year. It's not going to be 200. So me spending double the money is not going to lead to more market absorption than is going to happen naturally. You should feel really comfortable doing that because guess what? You know that way better than I know that. But it's my job to push you or push a founder, both on sometimes investing more, sometimes investing less. But nobody knows your business model better than you do. Nobody has an instinctive view of the market better than you do. So I would always tell you to trust your gut and then consult with people, obviously, debate it, but trust your gut.
Bringing things back to New York area startups, East Coast startups, as we move into this new phase of doing business and this new call for sort of maturity in the scale-up community, do you have a sense of whether you look at your portfolio of East Coast-based companies, if there's something about that relationship to the customer, something about the relationship to this market that makes them perhaps a little bit better suited to move into this next phase of growth?
Well, I think we talked about the customer. Look, first of all, obviously a lot of what drives location, let's be honest, is founder decision, right? The difference is it used to be that if you wanted to found a tech company or a software company, you felt the only way to do it. Jeff Bezos went across the country, ended up not going to Silicon Valley, but went across the country. But he went to the West Coast, even though it was maybe Seattle, because he believed the only place you could raise money for that idea was on the West Coast. I have a son who wants to be an entrepreneur. He doesn't believe he has to go to Silicon Valley. He's like, well, there's plenty of capital here. But he knows that, he's like, I didn't even know that. He's like, oh, Dad, Sequoia has an office in New York. This person, like my son knows all these firms have an office in New York. So his belief is there's not even the thing that he has to think about. Right? That I think is really, really important. Like you just have to care about your idea. And so a big part of this, let's be honest, is where people want to live. And I do believe that New York has become a much more relatively attractive place to live than almost everywhere else. That's one. Two, I do think you have so much industry in one place, financial services, healthcare, I can go through the list, where you have a disproportionate amount of headquarters in New York, and the ability to be able to meet with those people on a regular basis is great. There are things about cities in general, New York probably more, that, basic things that are kind of hard, like getting space. You're a fast-growing company, and you have to sign a 10-year lease and commit yourself to X amount of square foot. it's just a structurally, which is why you had these kind of WeWorks and things like that, but it's not enough structurally for companies to have, like, they need more flexibility. There's some basic infrastructure things that I think New York could do a better job on and create more flexible models around. And then the fourth, of course, is the ability to hire talent. And I think the ability to hire talent here is comparable to, look, on balance, is there still more talent in San Francisco than New York? Of course there is. I'm not going to, that has not totally changed. But there's sufficient talent. You know, we have about 70 companies just in New York City. Like, they're all finding talent where they need to find talent. And the last thing is, of course, just because you're a New York City headquartered company doesn't mean everybody has to be in New York, right? We're living in a different world, right? So we have lots of New York City companies that have development talent in India or development talent in Israel or development talent somewhere else. Companies are global. And so I think we also have to be careful. I know we're at the New York City Summit, so this might be sacrilege, but every company is increasingly global, right? And you have headquarters, and you're going to put people who are close to whatever function makes most sense to be in New York. And there's obviously, for the city and for the tax base, it's good to have as many employees here as we can, and the city should do the things they can to do encourage that. But let's also be realistic that talent is global, and we can find people anywhere. And that's how all companies are operating today.
Deven, you said a few minutes ago that you felt the US economy was fundamentally pretty strong. Any predictions on where you think the economy is going to go, and particularly what we might see with technology spending in 2025?
Yeah, look, overall, like, inflation is, I mean, you can look at the headlines of the New York Times, and inflation is hitting about a 3-year low. I mean, I think we'll probably have a 25 or 50 basis point Fed cut in the next period. I think we see a lot of, overall, we see a lot of stability in our portfolio, which was not the case, by the way, 4 quarters ago. So if we were doing this, you know, interview 4 quarters ago, I was not seeing a lot of stability. You're seeing much more seat contraction, particularly on seat licensed companies. We're not seeing that anymore because most of the headcount reductions that are happening, rationalizations that are happening, has kind of already happened. I think I just got an email, so I'm probably getting the data wrong, but we do a survey, I think, every quarter on, you know, on tech spend, and 65 to 70% of companies, I mean, I can forward it to you, but 65 to 70% of companies we're talking about tech spend stable or going up. Mm-hmm. Now, there's particular subsectors, and you won't be surprised by them. Cyber probably being one, cloud being the other, and AI being the third. I think AI is something like 70% AI spend is going up. And I think the AI thing has been, to me, the most eye-opening as it relates to enterprises. Right? We do these, I didn't talk about earlier on the value add team, we also have a kind of a customer introduction function for our portfolio. So we have 5,000 CIOs that we can introduce into our portfolio companies. We have a 15-person team that manages those relationships. And we'll periodically do dinners around topics where we'll invite CIOs of companies to come, and we'll invite some of our portfolio. This is now 4 or 5 months ago, but we did one on AI, and we invited all the big financial services companies from New York to come. So the big, you can guess, all the big money center banks. And we had our AI partners, and I think I was there just to host a dinner because I didn't have a lot to add. But I was stunned when I walked out because there wasn't a single company that was not spending, and one of the largest money center banks in New York had 230 separate AI implementations going on. And this is pretty early in AI. I remember doing a similar dinner like 15 years ago about cloud. And I had the CIO of Citibank, I had the CIA, I had like all these, I think, and I said, how many of you will be in the cloud in 5 years? I think 3 people raised their hand. Right? That was already 3, 4 years into the cloud. So the rate at which these technologies are being implemented has been remarkable. Yeah.
And even more remarkable, we've been on stage for 23 minutes, and it was the first mention of AI. So.
Well, you know, I think that, I mean, the interesting thing about AI is there's really 2, if you think about, and I'll spend a minute on it since we have a minute, there's really 2 fundamental areas of AI today. One's the model layer, and one's the application layer. right? So model layer being OpenAI and its competitors, and the application layer being companies that are effectively using models, but then putting some vertical expertise in. We're spending time on the latter, not the former, which is not a critique of anyone who's invested in the former. It's just the capital intensity of those models. And in our view, the potential commoditization risk of those models. I play around with them, right? And like, I use ChatGPT, and then I'll try Meta AI, and then I'll try Anthropic. I'll ask all three the same questions. They're pretty close, right? And so can you extract, how much value, long-term value extraction can you be at the model layer? I don't know. We don't know the answer, which doesn't mean that we're right. And not even that we're right. We just don't know how to think about it. So we're like saying, okay, we're not going to go there, but we do know that there is going to be a lot of value in verticals by taking these AI models, adding it with the workflow and proprietary data in those verticals, which you can charge for, and extracting a lot of value. So if you look at our portfolio of about 30 companies, they're really sitting much more at the application layer as opposed to at the model layer.
Yeah. Amazing conversation. A couple of takeaways: value in the application layer for AI. Founders should listen to their gut, but verify, trust but verify. And if I heard you right, New York is here to stay.
New York's here to stay.
Deven, Parekh, thank you so much.